Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over a bunch of different ratios. It's mainly precious metals ratios. And I was doing some thinking, and there's an energy crisis. It's obviously um, right here, right in front of us. And I was doing some thinking about kind of the build up to it. Back in 2019, there was a crisis in liquefied natural gas. It was basically a natural gas shortage. It started in Asia. Prices shot up. It was like $25 an MMBTU, and then it kind of came back down. But it just kind of, you could see a little blip in Europe. Then last year, uh, it happened again, and then Europe kind of blipped. This year, Europe is following Asia. Asia's going to the moon. Europe's going with it in terms of prices of natural gas. And you're seeing us blip. We're coming up now too. I think this is obviously all interconnected. I think that the energy crisis is starting to deepen its stranglehold on who's going to participate, which is going to be everyone. It's gonna suck the whole world in. And what happens is when you grow at exponential rates, you're consuming things at exponential rates, and you come up to a constraint of some sort. It's very hard to see it because a few years before it, there's no constraint anywhere near. But remember, we're growing at exponential paces. And not only is the demand growing at an exponential pace, your supply is also going to fall off if you don't invest more and more money into it. And that's exactly what's happened. We've got demand ramping back up vigorously, we'll call it. And we've got the supplies and investment going down. This is not a good mix for lower energy prices. This is a mix for incredibly high energy prices. And energy is the foundation of absolutely everything. It backs our currencies, it backs our bonds, it backs the future growth of stocks, because everything is a future projected growth and it's discounted to today, and that's what the stock is priced at. That is your PE ratio. That's your price to earnings ratio that you're paying for future growth. If we have an energy crisis and people figure this out and they start acting on it, and there's people like me that are positioning for it already. I've been positioning for this for a while. If they figure this out, what that's going to do is if energy prices increase, it's going to literally be inflationary because energy is used in absolutely everything. It touches all transport. It touches all products. Oil is the number one commodity, which is in plastics and all this stuff. So if that thing rockets higher, it's going to increase the price of everything. If everything increases in price, it means you have high rates of inflation. If you have high rates of inflation, it's going to put pressure on bond markets and currencies. Currencies are going to start falling and dropping like mad. You're going to see interest rates go up because bondholders are going to figure out, well, this is sticking around, inflation, and I need to be paid for it. So I got to sell all my bonds because I'm losing money. It puts it in a real negative rate. All that money is going to rotate. And there isn't much to rotate into because stocks are going to have to rotate out and bonds are going to have to rotate out. All of the money's been going into those sectors continually for the past 10, 11, 12 years. And if this occurs, and it is occurring, that money's going to have to rotate somewhere. And it's going to rotate, in my opinion, into commodities and precious metals. It just hasn't rotated there yet. And I was thinking today about precious metals, and I was getting a little down on it. I was like, these things are down. Like, it affected me. And then I came to the realization, like, I'm going to buy some physical. I'm going to buy some physical at these prices. What am I doing? Physical is the lowest risk way to play this. It is the lowest risk that I know of. It takes a ton of energy to get this stuff out of the ground. It takes a ton of energy to refine it. the cost curves on these things are going to blow up to the upside. And we can see the energy prices right in front of our eyes skyrocketing. This has to go up, in my opinion, at some point. I can't tell you what that point is. The timing is always the most difficult, and you don't have to time it if you cost average in and you buy your physical metals for cheap. Lowest risk, big reward, and we know the energy prices are skyrocketing. This stuff follows it. It follows it at a lag rate of 1.75 to 3.25 years. That's kind of when I shifted the charts. It's about that shift. Now, I can't tell you the exact timing, but it's somewhere around that range. And we had the COVID fallout, which I think we're following right now with the precious metals because it fell out and kind of went down. And then it started coming back up. And now we're really rocketing higher just recently, which means that gold and silver and all these things I think are going to account for it sometime very soon. I don't know when, but probably within a year or two. And I don't know, it'll probably start going up soon. I don't have the timing. I don't know the exact timing, but I've got some charts behind me. We'll go over the charts, and I'm going to be buying more platinum. I already purchased another ounce. I'm going to be cost averaging in. I'm going to buy another one tomorrow. I'm going to continue to buy into it. So that's what I'm doing. I think gold's a good bet too, and I think silver, gold, and platinum, and I'll show you why. So let's dive into the charts. This is just my financial opinion. You guys can take it for whatever it's worth. But so here's the CRB to SPX. So this is commodity to stock ratio. This thing is on fire. It's broken out. You can see this thing rapidly moving higher. What does this mean? It means that the commodities are outperforming stocks. It means people are going to notice this at some point, and they're going to shift their preference in investments towards commodities and away from stocks. Watch that 10-year yield as well. I go over it every single day in the gold and silver technical analysis update. The 10-year has been going up. I know they're going to try to hold it down, but I don't think there's any possible way. It's going to be too much money flowing out. And you're going to see a money rotate into commodities and precious metals. Commodities first, precious metals second. I've got a gold to silver ratio here. We broke to the upside when it got super cheap in COVID, and then we broke back down, and we're kind of almost doing a back test. Here's your breakout, and then a back test, and then it kind of rolls back over, and we'll probably compress later on. But that's the gold to silver ratio. It's at 78. It's pretty cheap for silver. Looking at the platinum to gold ratio, we broke out and we came back and back tested the breakout line. We're at 0.54, which is unheard of cheap levels for platinum. So platinum is incredibly cheap in relationship to gold. And we broke out and we did the back test. And this is where I usually like buying, is the back test. And what I'm doing is I'm taking my own advice and I'm buying a little bit more physical platinum. Here's the platinum to palladium ratio. We're in a downtrend. It did an accelerated downtrend, and then it bottomed when I swapped my palladium for platinum. We've been coming on up. We broke the first downtrend line. We came back to do a retest, and now we're coming back up. So I do think that this could be a potential outperformance, and I think it looks good. I think it looks good for platinum. Here's the platinum to silver ratio. Again, we were coming in this downtrend line. We were going to break in 2019, 2020. It didn't break. It did the COVID sell-off, and we're starting to come back up. So let's see if we can break this downtrend line where platinum outperforms silver. Platinum is cheap in relationship to silver at a 42 ounce silver to 1 ounce platinum ratio. The palladium to silver ratio looks like silver is outperforming palladium. That's why it's going down. If we draw a trend line in here, it looks like it's about to break or has broken. So I would prefer silver over palladium. Looking at the gold to silver ratio, what we're doing here is I'm looking at the last bull market. The last bull market started in 98, 99. It kind of went down, came over and went sideways before moving higher. So it really started to take off in about 2001, 2002. And then peaked at like 03, 04, 03, that's probably 02 here. Looks like 2000 to 2002. It pulled back, and then we took off again. This is the ratio. Keep in mind, this is the ratio. So the ratio didn't really go down till after the commodity boom. That's where it really accelerated. So we stayed in this 50 to 80 ratio. And that's kind of where we are today in the gold to silver ratio. We're about 80. So we were bouncing back and forth between 50 and 80. And that's, you can see this cheap one coming on down here. Looking at the platinum to silver ratio on a long-term perspective from 1970 all the way to somewhat recent, 2019 of March. I just want to give you a big picture view. You could see the commodity bull market was here to here, here to here, and we're starting one right now. Platinum is cheap in relationship. We're at about 42 ounces right here. We're at a very cheap ratio in relationship to silver, and silver's cheap to everything else. So it is incredibly cheap on a ratio basis. Here's the platinum to palladium price ratio. We are all the way down here below 0.5. It's right, the platinum to palladium ratio is right here at 0.51. So we come on back, we're right here at 0.51 in 2021. But looking back, this was an incredible time to buy platinum. And if you bought platinum in the late 90s, it looks like, and rode it all the way to 2008, and again, this is the platinum to palladium ratio, you could have bought roughly at 0.5 and sold it at 5.5. So 5.5 divided by 0.5 is 11. It's 11 times your wealth increase if you had bought platinum, rode it up to here, swapped it to palladium, and then came all the way back down and swapped it back to platinum. Now, platinum at a 0.5 again, that would also be 11. It'd be 11 ounces of palladium, and you could have 22 ounces of platinum. So right here, if you bought 1 ounce in the 90s, rode it all the way up, you'd have 11 ounces of palladium, and then you came all the way back down to 0.5 and swapped it, you'd have 22 ounces. You would have done a 22x on your entire wealth because you went from 1 ounce to 22 ounces of platinum. And obviously there's a little bit of friction cost in there, but it doesn't matter. That's an incredible return. Better than probably almost any stock that you could get from that time frame, or a lot of stocks. Maybe not any, but a lot. Here's the historical platinum to gold ratio, just to show you kind of what that looks like. We are where the star is at, and we are way below any other times in history. But one thing to look at in history is in the 1920s and even in the 1970 range, platinum outperformed gold all the way to a 5-to-1 and 6-to-1 ratio. That is insane. That is insane, especially from where we are today. It's almost like the 1800s when they were just found this stuff and didn't know what to do with it. But we're at incredibly low valuations, and incredibly high valuations. We could see some pretty dramatic outperformance of platinum if it were to repeat that way. Looking at some other ratios, this is the silver to oil ratio, which not a lot of people talk about, but we are very low in oil and about to almost break the lower end of the channel. Oil will outperform silver and probably break to the downside. And the last compression went all the way down to a little bit over 0.1. We started at 0.9. That is a huge compression against silver of an outperformance of oil. Looking at gold to natural gas, I'm just looking at natural gas because it's been going pretty crazy. We broke to the downside of its pattern, and we could see a big, large move in compression all the way down to maybe even 50 or 40 or 30, wherever this point is at the end of 2008, which means that we could compress from 306 down to 30 or so. That's a huge compression in natural gas and an outperformance of natural gas if it were to do that. And remember, gold could go up during this period as well or go down. I mean, it all depends. Now, here's the gold to oil ratio. We broke the downward channel trend line. So we are compressing, and we're probably going to compress all the way back down to somewhere down here, which could be a 5-to-1, 3-to-1 ratio. We could see a massive move in oil. And here is the oil to stock ratio. And I wanted to see what this was. This is the oil to S&P 500. I put the downtrend line in with all these hits, and we're just breaking to the upside where oil could potentially outperform stocks for a good long while. And if it were to go to the peak of 2008, where it peaked out, we could see a massive outperformance all the way up to maybe even 0.12. Now, what is that? What does 0.12 mean? So let me type in some stuff here and see what that means. So 0.12 divided by 0.018 is a 6 times increase outperformance of oil itself against the S&P 500. And obviously, if you play it with an oil company, you might get a 3-to-1 leverage. So it might be 20 times. You might outperform the S&P 500 by at least, I'm guessing, 20 times from where we are today. So there's a huge opportunity there in oil versus the S&P 500. Now I'm looking at some other stuff. This is platinum versus the S&P 500, just to give you a little more data. We got the downtrend line. It broke in 2019. We've been going sideways. I thought we were going to run up. We've been heading back lower. We're still above the trend line, but I'm going to be picking up some physical ounces here because I do think there's going to be an outperformance of platinum in relationship to the S&P 500. So what am I doing here? I'm looking at asset versus asset. And I'm trying to see what assets could outperform other assets. And coming into an energy crisis, anything that has energy as an input cost probably isn't going to be a good bet. It's if you're shutting down your electricity, or if your electricity prices are rocketing higher, your natural gas heating costs are rocketing higher, your transportation costs are rocketing higher, everything's rocketing higher around you. Your input costs for your products are rocketing higher, like your plastics and all that stuff. I would think that precious metals would be a very good spot to be, because all the energy is sunk into that metal to get it, and you can own it for something that is at lows. So this is what I would consider to be the least risk way, a strategy around precious metals swapping, where you can increase your ounces over time, like I did in the platinum to palladium ratio example. And we've got this, all these ratios are incredibly cheap for the metals, especially platinum. Gold, I think, is still a really good bet, and I think silver is a good bet. I think all of these are good bets. And these metals are used in a whole bunch of different things. Gold is a monetary metal, so that's your money metal. If you have an energy crisis, you could have problems in inflation, problems with interest rates going up because of inflation, and then money transferring out of bonds and stocks into what you hold, which is precious metals. Silver is the number 2 commodity. It's used in everything. The silver in your hand is going to be more valuable than silver in the ground. And I think energy companies might struggle, or I should say, silver mining companies or mining companies in general might struggle, because if you have very high input costs, what's going to happen is your silver price is going to rocket higher. If you own the physical silver, you have the least risk way to play the move. There's no nationalization. The taxes, for the most part, you can avoid if you own it physically, because what are they going to do? Come and start shaving some of it off? Whatever. But it's the least risk way, the most direct way to play it. And if you own the physical, that's what everybody wants. And if it's the number 2 commodity, it means it's used in everything, that a lot of people are going to want what you have. Platinum is a it's a very high melting point. It's very difficult to get. It's very deep in the earth right now of what's left. And we've got declining production since 2006. And it takes a lot of energy to get it, and a lot of energy to refine it, because it's a very high melting point metal. So if you own this stuff and you buy it when it's super cheap, all of the energy's been basically sunk into it to get it. And what you do is you buy it, and now the future stuff that they're going to get is going to increase the cost curves for the miners quite dramatically, is my guess. And if their cost curves are going up, what they're doing is it's raising the floor beneath you of your costs. And we are right at the high cost curve. We're right at the high end of the cost curves for like an Impala Platinum or something. So really what's happening is if production goes down because prices go up, their cost curves, they're going to produce far less of platinum. And if you're going to be riding it, we can ride that cost curve higher. So I think that that's a very good bet. I'm taking that bet because of the ratios are telling us that platinum is the cheapest metal of all of them. And looking forward, platinum is used in a hydrogen economy. So if we go the hydrogen route, they're used in hydrogen fuel cells. We could be using a lot more hydrogen. I mean, a lot more platinum in the hydrogen fuel cells. So it could be quite dramatic for the demand going forward for that particular application. Silver is used in all this stuff as well. So I think we're going to probably implement a mixture of everything: battery electric vehicles, hydrogen vehicles, and that is if we have the energy to mine all this stuff out of the ground. So it's going to be very interesting to see how very high energy prices impact all of these things. And I think these monetary metals that are used in everything, like silver, for example, could be an incredibly good investment. And with the least risk way to play it, the physical stuff, it's down right now. Maybe that's something to cost average in. I own a bunch of silver, so I'm kind of looking more to diversify out into platinum. So that's kind of where I'm looking. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.